Hello everyone, and welcome to your Money Your Way YouTube channel. Today, we're going to explore the fascinating world of Singapore REITs. We'll be discussing 5 REITs that have recently hit their lowest points in the past year and examining if they might be set for a comeback. Let's dive in. Please note that the content presented in this video is for educational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. The real estate investment trust sector experienced a temporary boost when inflation eased last year. However, with interest rates still hovering at multi-year highs, REITs are facing higher financing costs and lower distributions, leading to ongoing pessimism. Consequently, many REITs have hit their 52-week lows. The higher-than-expected inflation in the US has reinforced expectations that interest rates might stay elevated for longer. Here are 5 Singapore REITs that have recently touched their year lows. Could they be potential bargains worth considering? First up, we have Frasers Logistics and Commercial Trust, or FLCT. This REIT features a well-diversified portfolio of 114 properties across Singapore, the Netherlands, Germany, Australia, and the UK, with a portfolio value of 6.8 billion Singapore dollars as of December 31, 2024. The unit price dropped by 21.5% in the past year, hitting its 52-week low of 85 cents. FLCT maintains a high occupancy rate of 94.3% and achieved impressive positive rental reversions of 41.8% for Q1 financial year 2025. The aggregate leverage stands at a moderate 36.2%, with a borrowing cost of 3.1%. FLCT still has a debt headroom of 1.88 billion Singapore dollars before reaching the statutory gearing limit of 50%. Next, we have CapitaLand Ascott Trust, or CLAS. This hospitality trust has a portfolio of 100 properties across 45 cities in 16 countries, with assets under management of 8.8 billion Singapore dollars as of December 31, 2024. The unit price declined by 6% over the past year, recently touching its 52-week low of 85 cents. CLAS reported mixed earnings for 2024, with revenue and gross profit increasing by 9% and 10%, respectively, to 809.5 million Singapore dollars and 370.9 million Singapore dollars. However, distribution per stapled security declined by 7% to 0.061 Singapore dollars due to higher finance costs. The trust's revenue per available unit increased by 9% year-on-year to 176 Singapore dollars for Q4 2024. Additionally, CLAS acquired 2 freehold hotels in Japan for around 178.5 million Singapore dollars, providing a DPSS accretion of 1.6%. Our third REIT is Digital Core REIT. This data center REIT manages a portfolio of 10 data centers valued at $1.6 billion. Despite a more than 20% drop in unit price over the past year, Digital Core REIT reported resilient earnings for 2024. Gross revenue dipped slightly by 0.3% year-on-year to $102.3 million, and NPI decreased by 1.9% to $61.8 million. The REIT maintained a high occupancy rate of 97% and enjoyed positive cash rental reversions of 4.3%. The portfolio also has an aggregate leverage of 34%, with an average cost of debt of 3.9%, allowing the REIT to potentially fund acquisitions from its sponsor, Digital Realty Trust. Fourth on our list is Mapletree Industrial Trust. This industrial REIT boasts a diverse portfolio of 141 properties across 6 segments, including flatted factories, data centers, and high-tech buildings. These properties are spread across the US, Singapore, and Japan, with assets under management of 9.2 billion Singapore dollars as of December 31, 2024. The unit price has declined by 14% over the past year, recently hitting its 52-week low of 2 Singapore dollars and 1 cent. Despite the decline, the REIT reported commendable results for Q3 financial year 2025, with gross revenue increasing by 2% year-on-year to 177.3 million Singapore dollars and net property income rising by 2.6% to 133.2 million Singapore dollars. The distribution per unit also improved by 1.5% to 0.0341 Singapore dollars. The portfolio maintained a high occupancy rate of 92.1% and registered a positive rental reversion of 9.8% for renewal leases across Singapore. With gearing at 39.8% and a cost of debt of 3.1%, the REIT has the capacity to tap into borrowings for future acquisitions. Last but not least, we have Mapletree Pan Asia Commercial Trust (SGX) and 2IU or MPAC. This retail and commercial REIT owns 17 commercial properties across Singapore, Hong Kong, China, Japan, and South Korea, with assets valued at 15.7 billion Singapore dollars as of December 31, 2024. The unit price slid 13.8% in the past year, touching a 52-week low of 1 Singapore dollar and 16 cents. The REIT reported a downbeat set of earnings for the first 9 months of financial year 2025, with gross revenue falling by 4.6% year-on-year to 686 million Singapore dollars and NPI tumbling by 5.7% to 514 million Singapore dollars. DPU declined by 8.3% to 0.0607 Singapore dollars. Despite this, MPAC maintained an occupancy rate of 90% across its portfolio and saw a positive rental reversion of 4.6%. Shopper traffic at both VivoCity and Festival Walk improved, although tenant sales faced challenges. That's it for our review of 5 Singapore REITs that have recently hit their 52-week lows. Despite the challenges facing the REIT sector, these REITs have shown resilience and could be potential opportunities for investors. Remember, this content is for educational purposes only and does not constitute investment advice. Please seek proper guidance from a qualified financial advisor before making any investment decisions. If you found this video helpful, please give it a thumbs up